Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm Steve Sandusky, and as always, we got Bill Keen and Matt Wilson with us. Gentlemen, how are you today?
Well, we're doing well here in Kansas City, Steve. The tax day came and went last week. I think all of us are doing well on that front. Matt, I couldn't remember. You know, last time I asked Steve if he had filed, I think he had filed well in advance. I think you
Not well in advance. No.
Depends on how you define that, I guess.
Yes.
I'm terrible at getting my data together, so I feel bad for the tax preparer. So I tell him to go ahead and extend. You know, I'm fine doing that. Like, no need to rush through it. But the issue is when you extend, that doesn't extend your tax owed. So he's still like, well, I need the information to determine at least a rough estimate of what could be owed. So it's not like you just it's an extensive free get out of jail card. Just okay, we're going to do it later. It's like, well,
kick the can to October.
Yeah.
You have to. So what he's saying is you have to make sure that you get you get close on what you think you will owe by the time you do file before the extension deadline of October. And if you don't, then there'll be penalties. If you underestimate that, there'll be some form of penalty that would be assessed. So
yeah. Yeah, you might. I mean, people might wonder, like, well, then if you've got to kind of have an idea, then why don't you just do them?
Right. There could still be a K1. Who knows?
Well, that's some tax forms are just late, and there's nothing you can do about it. It's out of your control. So in those situations, they would probably most likely use last year's as at least here's a rough estimate. May not even be close to right, but you got to put some effort into figuring out what it could be.
Well, and I mean, now, you know, it's interesting because we talk about is it called the safe harbor provision?
Mm-hmm.
Is that what we call it? Yeah. So regardless of what you owe in the year you're filing for, if you withheld at least, is it 110% of what you
last year's,
the prior year?
Yeah. Or 90% of current.
I think it was 90%. Yeah.
Yeah. So it's either or.
Yeah.
So that way, if you've at least, hey, I'm going to pay in what last year, you won't get penalized. It doesn't change what you owe, but you won't be penalized.
But to make that clarification, if you're extending, I think at that point you still had to estimate what it was going to be. So that kind of covered you for the prior year. But if you're extending, I'm not sure that safe harbor thing.
Safe harbor doesn't apply to the extension
at that point. That's right. And then for those of us that pay quarterly estimates, just know the exciting new information. Not new. It's just exciting information. It's been the same way for many years. Your next estimates are due June 15th.
Well, your first estimate's due April 15th. Well, you pay your tax.
Well, of course. Yeah. So you pay your taxes. If you owe, you owe. If you're even, whatever, however that works out. But then you pay an estimate, first estimate, at the same time it's due. And then 8 weeks later, another one is due.
Yeah.
So that one comes quick. It's a little bit compressed there. So,
man.
Oh, yeah. Anyway, hey, if you're paying attention and you've got an idea what you're doing, none of this is a surprise, but it's kind of a fact of life here.
Yeah. And I've got those dates on my online calendar, those 4 quarterly estimated tax payment dates. And I usually put them like a week ahead of time in case I need to move some money around to pay. But, and I'm not a big fan of extensions. My tax person did that once or twice. And I'm like, I don't want this stuff hanging over. I want this stuff done by April 15th. I want to pay whatever I owe. And I don't want to think about it. And,
do you pay your estimates online or do you mail in checks, Steve?
I was just going to ask him that.
Yeah. No, I definitely pay online. Absolutely.
Make it easy. Yeah.
Yeah. Now this year was a little different because we moved from Wisconsin to Oregon. And so in 2024, we were part of the year in Wisconsin and the majority of the year in Oregon. And so we had to file a Wisconsin state tax return, an Oregon state tax return. I had to make estimated payments to Wisconsin early in the year, Oregon later in the year. And then, and I was pretty close overall between federal tax estimates and state tax estimates. I was within $2,000 of what I ultimately owed. So I thought my back of the envelope estimate of what I was going to owe was pretty close. So that was good. I don't like to get any big surprises in terms of either, owing a bunch of money or whatever. So I had to file the Oregon taxes in the mail because you got to go through like a full year first before they'll give you an online account. So I should be online going forward.
Well, interesting. You say, being close within a couple $1,000. We do a ton of tax planning. And part of that is just like, we're going to figure out withholdings with folks, especially when we're taking IRA distributions and how much do they withhold and what are the other withholdings from other sources of income, if any. And a long-term client was in earlier this year and he was kind of like, yeah, if we could get that within like $100, that would be great. And he's a golfer. So I said, okay, let me put this in golf terms. Within $100 is hitting a hole in one. Within $1,000 is probably being within a 1 foot putt. So like, that's the range that you've got to be comfortable with. I mean, we want to be as close as we can, but you got to give some, and he was laughing about that. It's like, okay,
Well, since you brought up golf, did you guys watch the Masters tournament?
I watched some of the highlights. I was in Charlotte at a road racing event. So during that weekend, so wasn't able to watch it in person.
Yeah, we had some of the family over here watching it on the big screen, and it was really fun to see Rory McIlroy pull it out in the I guess they call it sudden death playoff there, and one is now a Grand Slam holder.
That's right.
Yeah. So that was super cool.
Yeah.
So he'll pay some taxes.
Spitting image of a perfect swing.
Yes, he will pay some taxes, Bill. That's for sure.
Those winnings are not exempt.
No. But I'd rather have his problem than have the opposite problem of not having to pay taxes because I don't have any income.
Isn't that a theme that that folks like I guess suppose all of us and most of our listeners and viewers, where we all have that problem of prosperity that we do talk about. It's so easy to complain about the tax we pay, and rightfully so, I suppose. But I'd rather have that problem than
and have the money to pay the taxes
and have the resources to pay the taxes. That's correct.
It's a problem when you owe the tax and don't have the money to pay it. That's for sure.
Right. Well, that might be a nice segue in today's conversation, which is you guys have a recent client here that brought an interesting situation to you in terms of how their portfolio was currently being managed by another person. We're not quite sure if this is another advisor or just some other person that this new client knows. And you guys would actually do something a little bit different in terms of how you would have handled this. So what we want to talk about today is how to know if you're getting terrible investment advice. So we might have a little bit of fun with this one too. So Matt, why don't you just give us some of the highlights here of this situation, and that'll be a good springboard for us.
Yeah, this person reached out to us. I think just found us online, and they're local here to Overland Park, Kansas. So called in and spoke to one of our associates and got on the calendar, and it basically expressed just not satisfied with their current relationship. It was based out of somewhere in the East Coast, and said, we have phone calls every so often, but not often enough. And I don't think did much financial planning, more on the investment management side than anything else. So sat down with him, a single individual, and gosh, it was surprising some of the stuff that this person had. And it was, fortunately they're going to be fine, from just the financial planning side and not have to worry about running out of money or things like that. But it was just, it was bad. We were thinking, man, How can we help people? I mean, that's part of why we put the podcast out there and all of our webinars is like, we want to help people just be more educated about this stuff because it is complicated, and Wall Street has done a very good job of making it complicated and hiding all the fees, all these things that people don't understand. And, the regulatory bodies do what they can, but they can only do so much. Most of their solutions involve mailing out disclosures, and it's like, well, that doesn't necessarily do anything because the disclosures are written in legal terms that no one reads, and they're long, huge documents. So then it comes down to, okay, well, then how do you prevent people, make sure that they're trained and licensed and things like that? But then, part of this situation was we think it's a different person, but he had allowed someone to log into his account as him and place trades. So it's like, well, you can't really regulate somebody who may not be licensed and even holding themselves out as, a licensed financial advisor or a licensed, an investment advisor representative where there's licensing involved with the regulatory bodies and things like that. So it's like, well, how do you prevent that from happening? He's like, so let's talk through those things. Like, okay, well, what could have been some of the warning signs for this person to know, well, maybe this isn't the right fit for me when they're having those conversations?
Or to be educated about how the process works across the board, because this individual had worked a long career and had a good career and had saved some money, had over 7 figures of liquid assets and a home that was paid for, and had earned a nice Social Security benefit, had lived within his means. But as Matt mentioned, we got to looking and we saw, not only did we see multiple different types of annuities, some, I think one variable annuity, and then a myriad of other what are called equity index annuities.
Yeah.
We also saw those annuities inside of tax deferred accounts, so IRAs, and in one case, even inside of a Roth IRA. And an annuity, which typically an annuity is a tax deferred vehicle. So a lot of the times, most of the time, you don't have a tax deferred vehicle inside of a tax deferred vehicle. I suppose you could, but it doesn't necessarily make sense.
Don't you get double the tax benefit when you do that?
Yeah, negative taxes.
Doesn't necessarily make sense.
And it's kind of like, yeah.
Another thing Matt was mentioning too is, we're in this environment where folks they just don't have the education and training, and the media or the things that are being pushed toward the consumer, the media and sales folks, salespeople in the insurance industry and even financial product industry are going to be, especially in a time like today where we've had some volatility. We've talked about that on our last episode or two with the tariff situation, although the underlying economy still looks pretty darn strong. Matt's got a webinar coming up here in a week or two that he's going to talk about the data that he has for so many years. So I hope everyone will tune into that. That'll be posted on our YouTube channel as well and on our website. But the media and the sales, the financial product salespeople, especially in the insurance division, not necessarily to pick on them, but they use fear. Like a lot of times they use fear-based selling, and to get folks to kind of play on that, to get folks to make investments. And a lot of the investments are misrepresented how they actually truly work. They're only partially told. And I have a few pages in my book on that exact thing, that I think a lot of the salespeople that are promoting some of these instruments don't even know exactly how they work, much less able to explain it to a client. So we saw a myriad of those things in this particular gentleman's. I hesitate to even call it a portfolio, honestly, because a portfolio indicates that there's some sort of cohesion, and there just wasn't. But as Matt mentioned, a brokerage account custodied at one of the major custodians that he said he had an advisor on, but we couldn't see any advisor listed, and then found out, not to be repetitive here, but it's important to tell you the story, that the gentleman couldn't really articulate what the arrangement was with this quote advisor. All he knew was that they had his passwords to his login and would just log on and trade around. And
so logging in as the account owner.
Yeah, as the account owner, which would also have given him the ability to move money anywhere he wanted out of the account. And then the positions in that account were, Matt, were they options? They were a penny
Yeah.
stock that had gone bankrupt.
Mm-hmm.
50,000 that I saw was the cost basis. It had gone to zero, along with just truly a kind of a mess, honestly. So, for lack of a better term. So you look at all this, there were still some assets there, and some other normal things were in this portfolio, I suppose. But I'll tell you what, I'm super grateful that he got in front of our planners and we were able to discern this and help him get things straightened out.
Yeah. Yeah. So I think it's important we can talk through kind of the different pieces that he had and what would be, warning signs, because, he had been sold these products. The first thing that Bill mentioned, these annuities from, multiple different people. And here's kind of the warning signs to know if you're even going down that path with somebody. And a lot of the conversations are around guaranteed income streams, because that's what annuities can do. They're insurance products that can provide guaranteed income streams. There's a cost for it. I mean, it's like, you give them the funds and then they pay you out as like a pension plan would. Not real common as much anymore, those specific types of annuities, but they do exist. The other things that you'll hear with annuities, and more so on the type of annuity that this person had, which are called equity indexed annuities, you hear terms such as you get all of the upside of the market and none of the downside.
That's how they're sold a lot of times. Not every time, but a lot of times.
Here's when you hear that, let's just talk through that. Does that sound too good to be true?
Yes, it does.
Yeah. So let's just start there. If you ever hear anything that sounds too good to be true, definitely your radar should be kind of, flags should be going up, red flags that let's understand this more, ask more questions, do whatever you need to do to really understand it. Because if it's too good to be true, it typically is. All of the upside and none of the downside. Occasionally, clients and potential clients come in and we ask them questions around their investing, experience and history. And then of course, like what they're looking for. And sometimes that's, we want 10% returns and no risk. It's like, okay, well, we call that the unicorn portfolio. It doesn't exist. As much as I'd love that too. Everyone would love that. So all of the upside and none of the downside.
Well, if you're saying 10%, why don't you say 20%? You might as well go for it.
We got to be realistic here. I mean, 20%, that'd just be getting greedy. And, these people, a lot of times they're just doing it tongue in cheek because they know that's not possible. But occasionally people kind of think that should be, you guys should know, how to do that. And it's like, no one knows how to do that.
And when you say do that, what I think you're saying is, we've shared on this program the long-term history of the we call it the equity markets or the capital markets, the stock market, long-term history. It's about 10% across the board, going back 100 years or so. It comes in ebbs and flows. It's 3 steps forward, 1 step back, 2 steps forward, 2 steps back. Every so often, it's 2 steps forward, 3 steps back. It takes a year or two to come back. In some cases, in the worst cases, it takes a little longer to come back. But the market is constantly, the economic markets, the capital markets are, over time, and history has shown that they've always come back as the economy has grown and expanded, and GDP and our lives have gotten better, and all the things that happen with progress has reached new highs again. So that we have this, the equity markets is like going up an escalator. If you could imagine someone riding an escalator while they're doing a yo-yo. So that the trend is upward, but it's not straight up. That's a really simplistic way to get a visual of how the markets have worked over many years. And so when Matt says, do they think we can do that? That is what he's saying is that we should, a bell rings that there's maybe someone thinks
the market.
There's a bell that rings at the top of the volatility, and we were able to somehow get out and then get back in when the market bottoms. So another bell would have to ring at that point to tell you when to get back in. And that is impossible. It's impossible to do.
It doesn't exist.
Someone might think, well, I'm going to go to these high-flying financial advisors, planners, wealth advisors, investment, whatever, and they should know how to do that. And that's just a misconception. It's not an educated position. to be in. So it's really important to understand that's not possible. Now, there are ways to harness those cycle of the long-term markets. We share that a lot on our program, but the idea that you can get in or out, time the market completely is a fallacy. It's impossible. And if someone had ever figured it out, they would have all the money by now. And
they wouldn't have clients.
They certainly wouldn't have clients. They wouldn't be worried about investing your money because they would be investing their own money at this point. And so it's something that it's a kind of a fantasy that seems like,
well, it's another one of those too good to be trues too, because there are going to be people who do, salespeople that are going to present things as if that is possible.
Well, that's exactly what I was just thinking, Matt, when you said that, because there are now advisors, or I don't even hate to use that word, right? I'm really worried about semantics today.
I mean,
there are people out there that might give you a pitch that says, "Oh no, we have figured out how to see the time, and we have figured out how to time it." And they might even show you back tested numbers which is actually the SEC is on to that now, where people are back testing numbers, and they're just anybody can look backwards and say what you could have done, but they might be using that as a sales or promotional tool to make you think that they have figured something out that nobody's figured out yet.
Yeah. Or that they're pitching exclusivity. Hey, we got access to the top hedge fund managers in the world and things like that. And it's like, well, if they're so good, why do they need your money? Let's kind of think through all that. And it doesn't mean that anytime you hear that it's all bad, but it's just, there's again, the too good to be true. That type of concept is kind of what applies in a lot of these scenarios, because, this equity index annuity, I mean, we'll walk through kind of the numbers too, because, this individual provided us the statement and we were able to easily kind of point out, because he was kind of questioning it. It's like, well, I thought this was going to make what the market made. And here's what it says. But also, people that can say, well, we can, reduce the volatility and they can use some, technical trading strategy that's going to get out when volatility picks up. Well, what happens with those functionally in the real world is that this concept called whipsawed, meaning it markets drop quickly. Bill said there's an escalator with a yo-yo. Another way to look at it is like they take the escalator, markets take the escalator up and the elevator down. It may not go down all the way to the same starting point, but they can drop quick. And then you get stopped out in this strategy.
Stopped out meaning you get sold out, like you think they're going to figure it out. You get sold out based on this volatile thing.
And then the market comes back very quick, and now you bought back in higher. So at the end of the year, you made less return with the attempt to minimize volatility. And it's like, volatility is just part of the process. You can't really get around it without some sort of compromise. And that is typically lower returns, less volatility, lower returns. I mean, it's just, fish and market theories, how that works. And so, people get sucked into this stuff because they feel like, oh, well, this is great. This is exactly what I want. This whole equity index. I mean, again, we've talked about this for, ever since we started the podcast, because it is definitely a sales pitch that people they can get taken advantage of. So this person, they had a equity index annuity with, they're not inherently, I would say there's nothing wrong with them. I mean, these are put out by very large insurance companies. It's not like it's just some weird name. It's just they're misrepresented as to what they actually are and what their purpose and objective is.
A good portion of the time.
Yeah. I mean, and this person, so they put in, a couple $100,000 into this annuity back in 2007. So now we're going on, what's that?
18 years.
18 years. It's worth about $350,000, but that's not what you can. That's not like a withdrawal amount. It's the annuitization value. So this person, if they were to cash it in, they could pull out. They put in about 200,000. They pull out about 190,000. So 18 years later, they basically are just getting their money back. Now, well, what about
the lump sum back?
This 350,000? It's like, well, that lump sum is not available to you. You have to annuitize, meaning you give now all of that money to the insurance company and they just pay you an income stream based on your calculation for life expectancy. So that's how you actually get maybe the higher value, but you have to live and receive it over an annual, time frame. It's not something you can just transfer to something else. And of course, none of that stuff's explained to this person because they're like, well, what? I didn't know how any of that worked, because it's like, well, yeah, it is complex. Like, these aren't simple things. These are complicated tools that are put out there by these insurance companies, and they're confusing. It's just how it is. And that's we're not big fans of them because they're expensive. There's high expenses, and yeah, they're just not in the best interest of the consumer. About the only time I think we've ever really sat down with someone and thought the only way this is going to work is they're going to have to look at some sort of annuity solution, and it's someone who has a history of basically spending their money, like just cannot budget it, so almost preventing them from having access to the principal. It's just, you should just put it in an annuity and just receive X dollars a month for the rest of your life. And that's just what you can live on, because they had a history of, just taking out IRA distributions and paying all this tax and just not being able to budget. It's like, it's their funds to go decide what they want to do with, but it's like, that's about the time, where you look at that for people.
Well, we see when we get introductions to clients from personal injury attorneys,
Yes.
and someone's receiving a settlement from a personal injury lawsuit. Now, this could also be an inheritance. It could be a professional athlete gets a major contract. They've never had resources before. It could be, any number of ways of coming in. Lottery winner, I suppose, where they do offer monthly payments. But most recently, we had a personal injury attorney call us and say, hey, I'm sending somebody your way. They just need to get their annuity set up. And we're like, well, let's do a little more discussion here. What do you mean to get their annuity set up? Is there something that we need to understand? Like, they have to have an annuity, or what do you think? He's like, oh, no, sorry. I just meant that we just assume that every time a personal injury case has a large payout, that the people do an annuity. And by that, an annuity, it's funny because an annuity can either be a noun or a verb. In this case, it's a verb. And in my opinion, a verb in that instead of taking the $2 million or whatever it was, they're going to get their $8,000 a month or their $12,000 a month for life. And they don't get the 2 million or whatever the numbers are. That's off. You don't get that, but you get a guaranteed payment for life. And that is those streams of payments are called annuity payments. And that's, so it's up to us as investors or as advisors here at Keen Wealth to determine if all of our clients, none of them could handle their money. I guess that would be our only option, Matt. Those are called immediate annuities as well, by the way. You just give the insurance company your cash and you get a monthly payment for life, maybe a joint life if you're married, or
you can choose.
But like our clients that we work with, they have resources because they've been good stewards mostly of their situation, and they have a good relationship with their assets, and they're able to do better, not blow their capital or squander their resources by having it allocated the way that we typically
and it can be left to their beneficiaries, where these immediate annuities they're done when you pass away.
Right. That's right.
So it's like, there's a lot of downside to utilizing them. Back to the equity index annuity this person had. So put in a couple $100,000, this annuitization value is worth $350,000. And we're looking at, it's like, okay, well, how's that determined? And it basically says it's invested in the S&P 500 index. And this is giving a summary of the 2024 annual, here's the monthly breakdown of how your annuitization value increased over the previous year. Because they say, again, he was told all the upside, none of the downside. Well, the S&P 500, just so everyone knows, in 2024, it made 25%, pretty much flat. That was the total return for 2024. The way this annuity works, and this is how majority of equity index, they have a monthly cap. So the maximum return for his annuity was 1.25%
per month.
And it's a simple summation at the end of the year. It's not because, think about that. It's like, well, if the S&P went up 2% a month, like let's just say it averaged that in real life, it would compound it to, you'd get 2% and then you'd have 2% more. And then the next month, 2% more on top of the, this is not even compounding. It's just a simple math, which, okay, so there you're losing money. And two, the returns in the S&P they don't just come in a straight line every month. So this person, and here's the interesting thing. It showed what the monthly S&P 500 returns were. And oh, by the way, this doesn't include dividends. This is just price return. So dividends, as we've talked, can be a big portion of your overall total return. The S&P 500 had 3 negative months in 2024. Negative 2.8%, negative 0.4, and negative 0.4. Like those were the three throughout the entire year. It made 25% by the end of the year. The summation of his monthly capped rates, 7.5%.
Yeah, completely restricted. The return.
You start thinking through that, like, well, how do they get to 7.5% from 25 with only 3 down months? Well, the way it caps it at 1.25. So in month 1, the S&P was up 2.28%, and it was capped at 1.25. Month 2, up 3.8%, capped at 1.25. Month 3, up 3.3%, capped at 1.25. Month 4, down 2.8%. Well, the way this works is you get all of the downside to zero. So, I mean, it's like it won't go below zero, but it takes away 2.8% against the 1.25 that it's been capping. That's how it ends up with only 7.5% at the end of the year.
So if you look at that, and this is round numbers, but I have it in front of me as well, Matt. Mm-hmm. The first 4 months of the year, the first 3 months of the year, it was up 2.25, almost 4. Or the first month, February, almost up 4. The next month, about 3 1/3. So call that 10%. If I'm close there, the market was up. But the investor was capped at 1.25, 1.25, 1.25. The first 3 months, every month is capped at 1.25. So they were only up 3.75, and then in month 4, April, the monthly index was down 2.8%. So the market now was up about a little over 7, but their cap, that 2.8 wiped out most of the 3.75 they were up. So now you've got a massive disparagement between these two things. You've got the index that it was this formula is created on is up somewhere around 7% for the year, but you're only up 1%. The way the formula works. Believe me, these insurance companies are not stupid. They've got really smart actuaries putting together these monthly caps so that the cap on the upside it's capped. On the downside, each month it's not capped. It can take everything that it's down. So just think if you went all year and you were up 10 or 12% year to date in January or November, and then December has a tough month, it just wipes it all out. So this is what we've seen over many years. And I even write about this. I don't have what page it is in my book right here handy, although I do have my book handy. I won't burden you with holding it up, nor, maybe I will burden you with holding it up since on my YouTube channel, folks, Keen on Retirement Engineering, the Second Half of Life, second edition. I always say if anybody has an interest, send me an email or a note and I'll send one to you at no cost. I talk about it in there. And the first time I talked about it in writing was 2019. And then we did the update after COVID happened. But so this is not some new thing, but it just came across our radar very recently. And we thought it important to shine some light on these things and just bring some awareness.
Yeah. I mean, that's like, again, back to the kind of things to look out for. Too good to be true. I mean, it doesn't work that way. There is no magic bullet. No one's just giving you, the free lunch, as they like to say in economics. It's, there's trade-offs with how this stuff works. And, the other kind of piece to this individual situation too, that we wanted to bring, it was when he mentioned to us that he had provided his login to his his brokerage account to this person. Now, I think it's separate than maybe, this advisor. I'm not quite certain exactly, but they weren't listed on the statement. So like the way we work with our custodian is Charles Schwab. We, our kind of registered with them. We have to be approved to be on their platform. They don't just let anyone just show up. They have a process that they, look at, make sure you have cybersecurity, things like that. But it's not overly complex. I mean, a lot of people can get on there that maybe shouldn't be. And then we're listed on the statements or on their online access as, our investment advisor, your account is Keen Wealth Advisors. And functionally what that means is we have what's called a limited power of attorney, and we can trade on your behalf, provide paperwork to Schwab on your behalf, do certain things on your behalf. But we're doing that through our logins, we're not asking you for yours. We do it through ours. So when he said that, it's like, I hope there's money there, because the first thing I think of is that, well, money's just been stolen. Because if you're logging in as someone, you're logging in as the account owner, you can then set up all kinds of stuff, take distributions. They're Schwab, they do have, some level of verification and things like that, hopefully would prevent anything, too terrible from happening. But it can happen. Someone can pretend to be someone and take advantage of you. From our initial view of it, it didn't look like this was happening. So not quite sure exactly what this person was holding themselves as to look for or want to log in as the account owner. Like, kind of just like, what's their objective? Like, if they're not trying to steal the money, like, what are they doing? I don't quite understand. But we did look at the holdings. He provided us a statement, and it was, none of it was, appropriate for someone who's close to retirement and starting to pulling out a distributions from these accounts. I mean, it was mostly penny stocks, some very speculative ETFs that would, Bitcoin and things like that. I mean, if they're a small piece of an overall portfolio, that's one thing, but there was very large percentage of the total in these things. Options, just speculative, and it's like, options. Well, who is this person, and like, what kind of options? Because most options expire worthless. Like, that's what happens with most options. So it's like, are they even paying attention to them? Like, what's going on in here?
Now, do you know for sure that there was a second person that was logging in? Is there any trace of that person anywhere?
It was just him telling us. Okay. It might have been, presented as just a friend that, I guess, trying to help him out. I don't have any idea, but that seems a little. Even if I wanted to help someone, I wouldn't ask for their login. It's like, all right, let me help. I'd help educate you so you would understand how to make your decisions if you're just trying to manage it yourself. But I wouldn't just log in as you and do the stuff for you. You got to do that yourself.
Super risky. Yeah. Super risky. Yeah.
Yeah. I mean, so again, if someone's asking for your login, that's definitely okay. If you're sitting in a meeting, get up and walk away from that table. Like that is not an appropriate relationship. Bill mentioned the regulators earlier, and it's like, that is a very well-known no in our industry. We do not accept logins, because a client might say, hey, we're asking them for an update on their 401k balance, and they're so here's the log. Like, no, we can't log into your account. You've got to pull that up yourself. If we're on Zoom, like, we'll give you screen share. You take over the screen and you log in, and we can just look at it. But we do not log in on your behalf. That is definitely a no.
This is just the power of having, a compliance team on site, the power of having cybersecurity protocols in place, the power of having associate advisors and other lead and senior planners reviewing and checking work, senior management, a team that operates under the trading department and the portfolio management department, having that team working in place. We talk a lot about that fiduciary responsibility that we have at Keen Wealth, where we put the client's interest before our own. And there's, in my opinion now, there's no way someone could be operating a client's best interest if they're most likely, like this person that we've identified, are working as like a one man or woman shop, trying to juggle all those balls with no oversight whatsoever. Just that there's no way that could be in a client's best interest. That's my opinion now. And things like this can happen that we've identified here. Yeah. So no one's probably supervising this advisor, if it's even an advisor, looking at these allocations like this, these are things that would be, well, they would never happen at Keen Wealth because all of our assets get managed at the corporate level, headed up by Matt as the chief investment officer and followed closely by the compliance department. But it's just not to be, dramatic here, but, we're talking about people's life savings, and you want to give it the best shot you possibly can to make sure that things are handled correctly, and that it's taken seriously, and that, you've got someone working for you and you really understand it, think it through, like think through these things about who you align with to be your advisor and what the resources actually are behind that advisor and that team.
Yeah. I think that's kind of rolls into like this last kind of piece to it of, okay, other warning signs. Well, are they one, is there a team around them? Because, hey, that would be an idea of there's some checks and balances potentially within an organization. But then two, is the relationship built upon having a financial plan in place? Because that's, that was another question we asked this person was, well, have you done any planning with any of your advisors? It's like, no. It's like, even then. So it's like, well, then how do they determine if this equity index annuity is best for you? It's like, well, they don't. They just sell it to you. And, you just assume they're doing it because it's in your best interest. And it's like, no, they don't have that responsibility, for one, in those relationships. But then two, they're just selling you products. And that's what we really want to help people understand is like, are you getting involved in a relationship that's built upon, financial planning and a fiduciary duty, or are you just meeting with someone who's a product salesperson? And it can be difficult for people because they might have same titles and they might all be nice people and, they look the same and everything. But it's like, one of them is got a legal responsibility to do what's in your best interest. The other person just has to make sure it's suitable, which is not a very high bar to overcome.
Well, I would contend this brokerage account that we looked at today doesn't meet the suitability.
Well, that person, whoever sold him the annuity, does have to be licensed to sell annuities. There is
sell the annuities,
some level of that. It's not hard, but whoever's logging into her account, I don't think's even an investment.
Right.
Like,
well, they should have a license. They're it's probably don't. But the SEC frowns on those things. If not that our necessary listeners here today care, but if a firm like Keen Wealth manages under $100 million, you're required to register with the state regulators if you manage over $100 million. And Keen is, we're very grateful that we manage in excess of $1 billion. But if you're over $100 million, you register with the Securities and Exchange Commission. So, being registered and which is welcome, right? You want regulatory bodies to come in and to hold people accountable and to have rules and regulations that folks need to abide by. Which is actually, healthy in the long run or in the short run or in any run, honestly, for these markets and for the end client, which is what we're all here to support.
Yeah. Just to cover a couple other quick ones here in terms of what to watch out for. If you hear someone say, this is the system that Wall Street doesn't want you to know about.
Oh, we've seen that
right?
out a lot recently.
That sounds like a social media thing, Steve. I mean, we can talk about social media. That's the worst place to get financial advice.
Well, there's also friends and family in the barbershop too. Can be pretty bad.
There's a lot of, hey, I heard about this or that. Yeah.
Yeah. So if you hear anything along those lines, that's a problem. If you also hear something along the lines of, my friend is high placed in Silicon Valley and they work with Mark Zuckerberg and Elon Musk and Sam Altman. And this is the strategy that all of those folks are using.
Right.
That, we got the secret stuff, we got the secret sauce. Obviously that's going to raise a lot of red flags. I think another one would be if they're giving you more excuses than results. So if they do something and it doesn't work, and instead of owning up to it, they just make an excuse like, oh, it didn't work because of this or because of that. And then they just, try and get you on to the next thing. So, and I think if people just use common sense, you figure out this stuff, and you just have to have your guard up a little bit. If someone out of the blue is pitching you on something that, as we said earlier, if it sounds too good to be true, it most likely is. And that's when you call someone like Keen Wealth and say, hey, what is this? Is this legit? What's going on here? And keep you out of trouble there, save you a lot of money.
That's right. Matt, who do you blame for, and in our firm, it's been years, maybe one or two people every so often, clients, and most of the time it's people that haven't had to invest money long term, and they don't have wisdom from I always say wisdom from the journey of being a long term investor. They don't have that, so they've either come into an inheritance or some sort of a settlement, or they've worked somewhere where they haven't had to necessarily invest the money themselves. The company has put money in. A lot of the companies we work for have, or
Yeah.
that we do business with, are from employees that had ESOPs, and in those cases, and they worked hard to earn their ESOP shares, but a lot of those cases of folks hadn't saved a lot in the 401ks, honestly,
Yeah,
and
especially relative to the ESOP balance.
relative to the balances in the ESOPs. And the ESOPs are kind of on autopilot because they're company shares, and in some cases, they're
private.
a portion that are dividends that accumulated were actually managed by the company. And they've, in a lot of the cases we work with, they've done very, very well. So someone then comes out, retires from one of these companies or leaves one of these companies, and gets this big pool of money dropped in their lap, and they don't necessarily have the wisdom or education about how long-term markets work, about how there's a trade-off, there's a risk return trade-off. You have to decide up front where you want to be. You have to set your accounts up appropriately, and then it can allow a good advisor like our team, and there's others out there as well, fiduciary teams of advisors and planners and portfolio managers that are able to harness the cycles to be smart and prudent asset allocators among stocks and bonds, and then all of the subcategories among each of those asset classes. There's quite a few subcategories in the bond and fixed income markets and in the equity markets. There's small, mid, and large, domestic, international, value, growth. There's several different alternative investments as well. And then how do you allocate those assets so that you're happy with the long-term return that will be at play, and you're not always just unsatisfied that you didn't get into the hottest thing that happened last year. And in some cases, the S&P done really well. The Mag 7, you hear about that. The top big tech stocks. Why didn't we have our money there? Why didn't we just have our money there? And then why didn't we miss this? Why didn't you guys know the tariffs were coming? Why didn't you get out before the
I've
tariffs?
heard that.
We should have had the Mag. We should have had.
Everyone knew the tariffs were coming, and it's like, so you're telling me people predicted Trump's strategy?
Well, we did know they were coming. He talked about it his entire
but
campaign.
The market didn't know what. But no one in the market knew what his strategy was, and it's like, of course, no one knew what it was. So no one knew what it was.
So yes. But that thing about, well, we should have been in the text. I'm not saying any of our people have said this to us. I'm very grateful. We have a lot of people. We spend a lot of time educating people on this, though. And most of the people we work with have education from that journey of life. They built wealth on their own, and they've seen it play out. So they know better. But that temptation for someone to say, well, why didn't we own all the tech stocks, and then get out of those right before go to bonds because you can make 4% in money market, and then we'll get back. See, that's a fallacy. That doesn't exist. And what happens to people that try that is they in almost every case, at least in my experience, they dramatically cost themselves seven
they
figures.
End up selling low, more. Buying high. It's the opposite of buying low.
It's all emotion based, and it just creates a mess that it's almost hard to, it's almost a spiral you can't get out of, thinking that. And then in some cases they'll fall prey to some friend, a neighbor, or some advertisement that says, no, we have figured it out. You can get this special thing. And next thing you know, they've got a pool of assets that would have maintained their lifestyle forever. And they're chasing this thing, this imaginary thing that doesn't exist, to their detriment. And I said a moment ago, 7-figure mistakes. I mean, depends on how much money you have. That they're not all 7-figure mistakes, but if you have, several $1 million portfolio or more, it could easily be 7-figure mistakes that you can make, getting sucked into some of that. So, as you said, Matt, having a financial plan in place, and you mentioned planning being the basis for all of this. Planning, what does that mean? It means that you've sat down and you've looked at the things that are most important to you and your family. You've looked at what your taxes will be, not only this year, but in the future, based on current law and what we think how it might change. You look at how things are titled. You look at your estate plan. What happens if something were to happen to you and or your partner or spouse, not only now, but in the future? How are things titled? How are they set up? What are your insurances? What do your health insurances look like? How will you be pulling money out? How much do you need to live on today and in the future? What are your goals? What are your dreams? What are the things you'd like to do? What are your charitable endeavors? All of these things feed into that financial plan, and it's always changing. That's the power of the process. And we've trained our advisors here. We haven't really had to train them on this piece of it. They all have this real passion and desire to have that kind of intimate relationship with our clients over many years, decades, and generations in some cases, to walk that path alongside these folks, to constantly be meeting and bringing everything back to center on the plan. And then the investments are just the engine to the plan. The investments are the engine. They're equally as important, but they're secondary. You have to have a direction before you put fuel in and press the pedal down. And that's what this process we're talking about. So we're in the unique position of getting to see a ton of different scenarios that get referred to us, introduced to us, clients coming to us looking for help, and we get to help them sort through that and kind of put that perspective out there so folks can kind of get their mind around clarity around their financial house and bring things together in a cohesive nature that gives us the best shot, the best opportunity, the best probability of hitting all those goals and doing it with some peace of mind, being able to sleep at night and not getting distracted and sucked into in my book, I call it the second edition, the next flash in the pan. It'd probably be good to go back and take a look at that as well, that chapter, for those of you that have that book in your possession.
Well, Bill, your passion is showing through here, man, just how passionate you are about what you're doing here. And Matt, same thing as well. And I think that's probably a great place to wrap up today's episode. And if any of you listening would like to learn more, please visit us at keenwealthadvisors.com. Of course, if you haven't subscribed to the podcast yet, please do that on your favorite player. Please leave us a review if you're so inclined. We also have the YouTube channel for Keen Wealth Advisors, so make sure that you're checking that out as well, and tell all your friends about us. We appreciate that. So Bill and Matt, as always, thank you. Another great episode, another important episode. So I appreciate you guys being here today.
Thanks, Steve. Thanks, Matt.
All right.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.